So, more proof that we are going into a deflation first. This is what a dead cat bounce looks like. This is the stock market. So stock rises, it peaks, takes a little dip. A bunch of investors come in thinking that they're scooping up deals, and they start buying, and it rises again, and then the crash continues because when they started buying, it hadn't reached fair value yet. It had just rolled over, taken a little bounce, and the market is still looking for fair value. So there's the dead cat, and it bounces. There's the NASDAQ. So that's what a dead cat bounce looks like. The initial crash on the NASDAQ was 38%. The total crash was 78%. This is the Dow in the 1929 crash, and a dead cat bounce. The initial portion of the crash was 48%, and the total crash was 90%. So in the first example, it was 38%, 78%, 48%, 90%. So if the initial crash is larger, the rest of the crash is going to be larger. We are going through a giant version of the 1929 crash or the NASDAQ crash. We just had the biggest crash in history. The Dow, which is supposed to be the biggest, safest, securest, the 30 largest companies in the United States, just crashed by 56%, and we're in a dead cat bounce, meaning that ultimately the total crash should be greater than 90% from its high.